Most people think rich investors wake up and do something secret, like they check one magic chart, or they get a text with the next big stock, or they make one bold move and win. That is not how quiet wealth is built. Quiet wealth is built in a way that feels almost boring. It is built by people who can ignore noise, people who can wait, people who can stay calm while others chase quick wins. And here is the hard part. The market today is built to make you impatient. It pushes fear and hype all day. It rewards loud opinions. It rewards action. It makes you feel like doing nothing means you are falling behind. But doing nothing can be the smartest move. If nothing is part of a good plan, this video is about 5 things rich people do every day that quietly build wealth. Not 5 tricks, not 5 hot picks. These are daily actions that protect your money and your mind. They help you think clearly. They help you avoid big mistakes. And they help you avoid big mistakes. And they help you give compounding time to work. Also, let's be honest. The biggest danger in investing is not that you miss one winning stock. The biggest danger is that you keep making small emotional mistakes over and over. A little FOMO here, a little panic there, a little buying because people online sound sure. Those small mistakes can cost you years. So the goal of this video is simple. Build a daily process that keeps you rational, that keeps you steady, that keeps you thinking like an owner, not a gambler. And before we start, one rule: this is not personal money advice. This is education. These are principles, no promises, no quick results, just a better way to think. Now, let's get into the first daily thing. The first thing rich people do every day is this. They ask an owner question before they look at the price. Most people do the opposite. They look at the price first. They see green or red. They feel something right away. Excited, scared, curious, angry. Then they try to explain that feeling with facts. That is backward. Rich investors flip the order. They start with the business, not the ticker, not the chart, not the trend. Here is the owner question. Ask it slowly. If the stock market closed for 5 years, would I still want to own this business? This one question changes everything because it forces you to stop thinking like a trader. Traders need movement. They need action. They need the next thing. Owners need strength. Owners need a real business that can survive hard times and still grow over many years. When you ask this owner question each day, you build a habit. You train your brain to focus on what matters. You stop letting the market control your mood. Now you might think, but how do I know if I would want to own it? Good, that is the right question. And you do not need a fancy model to start. You need a simple checklist. A short one you can use daily. Here's a daily owner checklist. 5 quick lines. You can write this in a note app. 1. What does this business sell? Say it in one clear sentence. If you cannot explain it simply, you do not understand it yet. 2. Why do people buy from them? What problem do they solve? What makes people come back? 3. Who is the real competitor? Not just other stocks, real companies that take the same customer. 4. What could break the business? Think of real risks. Too much debt, a new law, a better product from someone else, a big drop in demand, a bad habit of raising costs. 5. If nothing about the business changed, would I feel okay holding it even if the price dropped a lot? That last question is about you, not the market. Because a big part of investing is knowing your own limits. If a normal drop would make you panic, that is not a market problem. That is a planning problem. Rich investors do this daily in a quiet way. They might read one page of a report, or check one business update, or review one note they wrote before. They are not hunting drama. They are building understanding. And this leads to a word that matters a lot in value, investing. Moat. A moat is a strong defense. It is the reason a good business can keep winning, even when others try to copy it. A moat can look like many things. It can be trust. It can be low cost. It can be a network of users. It can be switching costs, where it is painful to leave. It can be scale, where the biggest player gets better and cheaper over time. You do not need to name every moat like a textbook. Keep it simple. Each day, ask this one moat question. What makes this business hard to replace? If you do not know, that is fine. It means you need more time. It means you should slow down. And slowing down is not weakness. It is a filter. Now let's talk about a common trap. A lot of people say they are long-term investors, but they still act like short-term traders. They check prices 10 times a day. They feel proud when they buy before a jump. They feel shame when they buy before a drop. They feel like the market is judging them. Rich investors do not live like that. They protect their mind. They know emotions create bad timing. So they do something simple. They build distance between themselves and the noise. That is why the owner question comes first. It creates that distance. It pulls you back to what is real. And if you want an inner dialogue for this, use this one. It is short and strong. Price is not value. Mood is not truth. I own a business, not a beep on a screen. Say it when you feel pulled by hype. Say it when you feel pulled by fear. Now, the second daily thing rich people do is this. They keep a not yet list and they use it to kill FOMO. FOMO is not just a feeling, it is a pattern. It starts the same way you see a stock everywhere. Online posts, friends, headlines, big claims. People act like it is obvious. They act like it cannot fail. They use words like guaranteed or next big thing. And your brain does something fast. It says, if I do not act, I will miss it. That thought is the trap, because the market will always offer another story. Always. If you chase stories, you will always feel behind. Even if you win once, you will try again, then again, then again, then again, and one day you will pay the bill. Rich investors are not immune to FOMO. They just handle it better. They do not fight it with willpower. They fight it with a system. The system is the not yet list. This is a simple list of things you do not fully understand. Yet you are not saying never, you are saying not yet. That one phrase saves people from so many bad choices. Here is how you use it daily. When you feel FOMO, do not open the chart. Open a note, write the name of the business or the topic at the top. Then answer 3 simple questions. If you cannot answer them in plain words, it goes on the not yet list. Question 1, how does this business make money? Where does the cash come from? Question 2, what is the biggest risk that could cause long-term damage, not a one-week drop, real damage? Question 3, what would I need to learn to understand this well? 1 report, 1 basic book, 1 simple source. That is it. This takes 5 minutes. It turns FOMO into a learning plan, and it forces honesty. Because many people do not lose money from being wrong. They lose money from pretending they know. The not yet list is not a list of shame. It is a list of discipline. And it connects to another key idea in value investing. Your circle of competence. Your circle of competence is what you truly understand. Not what you heard, not what you hope, what you can explain, what you have studied enough to see both the good and the bad. Rich investors respect their circle. They do not try to have an opinion on everything. They do not need to be in every trend. They would rather miss 100 exciting stories than hold one business they do not understand in a panic. So each day, they do small work that makes their circle stronger. That work can be simple. Read a few pages, review old notes, learn 1 term, understand 1 industry rule, 1 step. Here is a daily learning rule you can use. It is easy. 10 minutes a day, no hype. 10 minutes, not 2 hours, 10 minutes. And no hype means this: no shouting headlines, no angry debates, no predictions, no clips made to scare you or pump you up. Instead, choose calm sources. A company letter, a basic business article, a simple finance book, a clear explanation of how an industry works. Then write down 1 thing you learned in 1 sentence, just 1 sentence. This is how knowledge compounds, quietly, slowly, but it sticks. Now let's add a decision rule. Because rich investors love rules. Rules protect you when emotions rise. Here is the rule. If I cannot explain it simply, I do not buy it. Notice what this rule does. It does not say you will never invest in new things. It says you must earn the right first. You must understand before you act. That 1 rule blocks many bad moves during social media hype. And there is another rule that works well with it. If I feel rushed, I wait. The market will always try to rush you. Act now, before it's too late. Before the next move, that pressure is a signal. It is not a reason to act. It is a reason to slow down. Now you might be thinking, okay, I can think like an owner, I can avoid FOMO, but how do rich people decide what is a good price? How do they avoid overpaying? Good. That is where most people break. Because even if you find a great business, you can still pay too much. And paying too much can turn a good business into a bad investment experience. It can test your patience. It can test your emotions. It can tempt you to quit at the worst time. In the next section, we will cover the 3rd daily thing rich people do. They keep a watch list with simple value ranges, not exact numbers, ranges, and they use a margin of safety so they do not need perfect timing. We will also talk about how they judge business quality in a simple way, how they spot a real moat versus a popular story, and how they build a plan that keeps them steady when prices drop fast. For now, take this with you. Ask the owner question before you look at the price, and when hype pulls at you, put it on the not yet list. These two habits alone can change your behavior because they move you from reaction to process. And process is where compounding starts. Now let's go to the third daily thing rich people do. This is where most people get into trouble, not because they pick the wrong business, but because they pay the wrong price. A great business can still be a bad deal if you overpay. And overpaying does something sneaky to your mind. It makes you impatient. It makes you sensitive to drops. It makes you doubt yourself faster. And it makes you more likely to sell at the wrong time, not because the business failed, but because your emotions got tired. Rich investors try to avoid that trap with one simple habit. They keep a watch list with value zones, and they update it a little each day. Most people use a watch list like a scoreboard. They watch what is going up. They watch what is hot. They watch what is trending. Rich people use a watch list like a shopping list. It is calm. It is planned. It is written down before emotions hit. Here is the key idea. The market is not a teacher. It is a mood swing. Some days it offers fair prices. Some days it offers silly prices. Some days it offers panic prices. Your job is not to react. Your job is to be ready. So the daily habit is this. For each business you follow, you write down two things: business quality and price discipline. Start with business quality. Keep it simple. You do not need fancy words. You need clear thinking. Use this quick quality checklist. You can do it in 5 minutes. First, the engine. What makes the business earn money year after year? Is it repeat buyers? Is it a service people stick with? Is it a product that is needed often? Second, the moat. What keeps others from copying it fast? Is it trust? Is it a network? Is it switching costs? Is it a scale that makes costs lower? Third, the people. Do the leaders sound honest and steady? Do they admit mistakes? Do they talk about long-term goals, not just short-term hype? Fourth, the balance sheet. Does the business rely on a lot of debt to look strong, or can it handle a hard year without begging for help? Fifth, the red flags. What could truly hurt it for a long time? One big customer leaving, a new rule, a cheaper option, a tech change, a weak brand. When you write these down, you are not trying to be perfect. You are trying to be clear. Now comes price discipline. This is where value investing becomes real. You do not need to guess the exact correct price. That is a trap. The future is uncertain. Your job is not to predict. Your job is to avoid big mistakes. So rich investors use ranges, not single numbers. Think of it like buying a used car. You may not know the exact value down to the dollar, but you can still know the difference between a fair price and a crazy price. Here is a simple way to build value zones. You create 3 zones on your watch list. Zone 1, too expensive. The story may be great, but the price leaves no room for bad news. Zone 2, reasonable. The price may be fair, but you still need to be careful and patient. Zone 3, attractive with a margin of safety. The price is low enough that you have a cushion, a buffer, room for error. That cushion is called a margin of safety. Margin of safety is not about being negative. It is about being realistic. You are admitting something that most people hate admitting. You could be wrong. The world could change. The company could face a problem. Your estimates could be off. So you build in space, like wearing a seatbelt even when you are a good driver. Now, how do you set these zones without becoming an expert with spreadsheets? Start with a simple value anchor. One sentence, not a full model. Ask this: what would a calm, rational owner pay for the future cash this business can likely produce? You can use simple signs to anchor your thinking. Things like long-term profit history, steady demand, and how strong the business is in its field. You are not chasing perfect math. You are building a range that is not crazy. Then you add your margin of safety. Rule. You decide it before you feel emotion. Here is a clear decision rule you can write at the top of your watch list. I will not act when I feel rushed. I will only act when price and value make sense, with room for bad luck. You can also add another rule. If I cannot explain why it is cheap, I will not call it a bargain. Because cheap prices often show up for a reason. Sometimes it is a mood swing. Sometimes it is real damage. Your job is to tell the difference. This is where a short daily routine helps a lot. Each day, pick one business on your watch list. Just one. Then do this quick review. What changed since yesterday? Price, business, or both? If only price changed, ask why. Was there news? Was it just market fear? If the business changed, ask what kind of change it is. Temporary pain or long-term harm? Then update one line in your notes. One line only. Keep it small. Keep it steady. This is how you build an investor brain, one brick at a time. Now, there is another part of this that rich people do daily, and it sounds almost too simple. They write down their no list. Most people think wealth comes from finding yeses. The next big yes, the next big winner. But in value investing, most of your power comes from saying no. No to hype. No to prices that make no sense. No to businesses you cannot explain. No to pressure. So write a short no list, 3 to 5 items. Here are strong examples. No to businesses with unclear profits. No to stories I cannot explain in 1 minute. No to prices that assume perfect growth forever. No to heavy debt that could break the company in a bad year. No to buying just because others are excited. This list protects your time, it protects your focus, and it protects your money from you. Now we move to the fourth daily thing rich people do. This is the part nobody wants to practice because it deals with fear. They run a volatility drill every day. Volatility is just a fancy word for big price moves, up and down. Most people think the goal is to stop feeling fear. That is not the goal. Fear is normal. Fear is human. The goal is to stop fear from making your choices. The market has a pattern. When prices rise fast, people feel smart, they feel safe, they take more risk, they stop asking hard questions, they start believing the crowd. When prices fall fast, people feel trapped, they feel foolish, they imagine worst-case stories. They sell to stop the pain. In both cases, the market is pulling a string, and most people move like a puppet. Rich investors cut the string with rules. They do not wait for a crash to decide how they will act. They decide now, while calm, while clear. Here is a simple daily volatility drill. It is short. It is not dramatic. That is the point. Step 1, ask. If my best business dropped 30% this month, what would I do? Not what you hope you would do, what you would really do. Step 2, if your answer is I would panic, then do not judge yourself. Just learn from it. It means your risk is too high for your current comfort, or your understanding is too low, or both. Step 3, write a calm plan. Use if, then rules. Rules are your guardrails. Here are strong if-then. Rules you can copy. If I feel a strong urge to act right now, then I will wait 1 full day. If I cannot explain the reason for the move, then I will not make a big change. If the business fundamentals did not change, then I will not treat the price drop as proof I was wrong. If the business fundamentals did change, then I will write down exactly what changed and whether it is temporary or permanent. If I am losing sleep, then my position is too big for my temperament. That last one is important. Many people think risk is just numbers, but risk is also behavior. If your plan makes you lose sleep, you are more likely to make a bad choice under stress. So rich people shape their plan around staying steady. They also do something else. They keep a panic note. A panic note is a short message you write to yourself on a calm day. You write it before the storm. It is what you want your future self to read when prices are falling and your brain is loud. Here is a simple example. Keep it in your notes. Volatility is normal. Price is not the business. I will not make decisions to escape fear. I'll check facts, not headlines. I will follow my rules. This may sound small, but it works because in a panic, your mind narrows. You forget. You only see danger. A calm note brings your thinking back. Now let's talk about information overload because it makes volatility worse. During market drops, news gets darker. Feeds get louder. People post strong opinions. Some act like the world is ending. Some act like it is a once-in-a-lifetime chance. Both sides are trying to pull you into action. Rich investors limit their inputs. They treat their attention like a scarce resource because it is. So here is a daily rule that helps slow information. Fast thinking. Slow information means you pick a few calm sources and you ignore the rest. You do not need 20 opinions. You need a few facts. Fast thinking means when you see a scary headline, you do not let it sit in your body like poison. You ask one of these questions right away. Is this about the whole market mood or is it about this business? Is this new information or old fear with new words? Does this change the long-term earnings power of the business? Yes or no? If you cannot answer, you do not act. You wait and learn. Waiting is not weakness. Waiting is a position. Now, let's add one more tool. This one sounds cold, but it is kind. It protects you from self-hate during hard times. Separate bad outcome from bad decision. Sometimes you make a good decision and get a bad outcome. The world is uncertain. Sometimes you make a bad decision and get a good outcome. That is luck. Rich investors do not judge themselves by 1 month, or one headline, or one drop. They judge themselves by process. So each day, ask this process question. Did I follow my rules today? Not did I win today? If you follow your rules, you are building the only thing you can control, your behavior. Now, let's go. Connect the third and fourth things because they work together. Value zones help you avoid overpaying during hype. Volatility drills help you avoid panic during fear. Together, they do one powerful thing. They keep you from buying high and selling low. Not by magic, but by design. Most people do the opposite because they do not have a plan. They build their plan in the middle of emotion. Rich people build their plan before emotion. Then they follow it, and they keep it simple. Because simple plans are easier to follow when your heart is racing. So here is a short daily combined checklist for things 3 and 4. You can do this in under 10 minutes. Pick one business on your watch list. Write one sentence about the moat. Write one sentence about the main risk. Mark the current price zone, too expensive, reasonable, or attractive with margin of safety. Then read your if-then rules once. That's it. Small steps, every day. That is how calm confidence is built. Now there is one last daily thing rich people do that ties everything together. It is not about charts. It is not even about picking businesses. It is about protecting compounding from leaks in your life. Things like lifestyle creep, impatience, and the need for excitement. Because even a strong investing plan can fail if your daily life pushes you to take dumb risks. In the next chunk, we will cover the 5th thing rich people do every day that quietly builds wealth. Then we will put all 5 into one simple routine you can follow without stress. And you will have a clear way to stay steady when the market tries to pull you into hype or fear. Now we get to the 5th daily thing rich people do. This one is quiet, and it is the reason many smart investors still fail. They protect compounding from leaks. Most people think wealth is only about what happens in the market. They think the whole game is picking the right stock at the right time. But compounding is like a bucket. You can pour in good returns. You can work hard, you can be right about a business, and still end up with less than you should if the bucket has holes. Those holes are not always bad investments. Many times the holes are outside the market: lifestyle creep, fees, taxes, debt, impatience, and the need for excitement. Rich people do a daily leak check. It is not dramatic. It is not perfect. It is just consistent. Because the person who keeps more of their money and stays invested through storms often wins over the person who is always chasing a bigger score. Here's the truth that is a bit polarizing, but it is real. A lot of people do not have an investing problem. They have a spending and patience problem. They keep looking for a faster way to grow money because they are leaking money every month, and they want the market to fix what their habits are breaking. Rich investors do not think like that. They know the market is not a rescue plan. It is a long game. So what does the daily leak check look like? It is a short set of questions, 2 minutes, honest answers. Ask these every day. Did I spend money today to impress someone? Did I buy something that raises my normal life cost for no real reason? Did I add a new monthly bill that will be hard to remove later? Did I use debt for something that does not help my future? Did I make a money choice because I felt bored, stressed, or left out? That last one matters more than people think, because boredom and stress create the worst money choices. The treat yourself choice, the I deserve it choice, the everyone else has it choice. These choices feel small, but they repeat. And repetition is what makes compounding work, both good and bad. Now let's talk about a modern leak that did not exist like this before. Our information diet. Most people do not notice it, but their content changes their risk level. If you watch hype all day, you start thinking like a hype person, even if you do not want to. If you watch fear all day, you start thinking like a fearful person, even if you do not want to. So rich investors protect their mind with a simple daily rule. They choose calm inputs. They do not feed their brain with content that is designed to trigger emotion. They ask one simple question about any investing content. Is this trying to inform me, or is it trying to control my mood? If it is trying to control your mood, it is usually noise. Noise makes you trade more. Noise makes you switch plans. Noise makes you forget what you own and why you own it. And switching plans is one of the biggest enemies of compounding. Because every time you change your plan, you reset your learning. You reset your patience. You reset your trust in yourself. Rich people do not chase new plans all the time. They build one simple plan and improve it slowly. They treat investing like planting an orchard. You do not dig up the trees every week to see if they are growing. You water them, you protect them, you remove weeds, and you wait. Now there is another leak that sounds small but is huge over time. Fees and friction. Every time you trade, there is a cost. Sometimes it is a visible cost, sometimes it is hidden, sometimes it is taxes, sometimes it is the spread, sometimes it is this bad timing caused by emotion. Rich investors think in after-cost terms. They do not ask, how much can I make? They ask, how much do I keep? So here is a daily decision rule that helps. If the main reason to act is boredom, I do nothing. Because boredom trades are expensive. They are not based on value. They are based on feeling. Here is another daily rule. If I cannot explain the RSO done for this action in one calm sentence, I do nothing. This rule sounds simple, but it blocks many bad moves. Now let's connect this to the title again. These are things rich people do every day that quietly build wealth. Notice the theme. They are not trying to be right today. They are trying to stay in the game for a long time. Staying in the game is a skill. And staying in the game means you must avoid the big mistakes that knock people out. Big mistakes often come from the same place: overconfidence in good times and fear in bad times. So the fifth habit is about protecting your behavior across both. In good times, you protect yourself from lifestyle creep and greed. In bad times, you protect yourself from panic and self-doubt. Now let's make this very practical. Here's a simple daily routine that includes all 5 things. It is short on purpose, because the best plan is the plan you can repeat. This is a 12-minute routine. You can do it in the morning or at night. Same time each day helps. Minute 1 to 2. The owner question: pick one business you own or one you want to own. Ask, if the market closed for 5 years, would I still want to own this? Then write one sentence. The business is stronger, or the business is weaker, or no real change. Minute 3 to 4. The not yet list. Write down one thing you do not understand yet. Then write one learning step. One small step. Not a huge promise. Example, read the business model section of the annual report, or learn what drives prices in this industry. Minute 5 to 8. Watch list value zones. Pick one business on your watch list. Mark the zone. Too expensive, reasonable, or attractive with margin of safety. Then write one sentence about the moat. Then write one sentence about the biggest risk. This keeps you focused on quality and price, not noise. Minute 9 to 10. Volatility drill. Read your if-then rules once, just once. If you do nothing else, do this. It keeps your rules fresh in your mind. Minute 11 to 12. Leak check. Ask, did I leak money or focus today? If yes, write the leak in one sentence, no shame, just truth. Then write one fix in one sentence. Example, unfollow accounts that push hype, or stop one extra subscription, or pack lunch tomorrow. That is it. This routine is not exciting. That is why it works. Now let's add a simple weekly reset. This helps you stay consistent. Once a week, pick a calm day. Set 20 minutes, do 3 things. First, review your watch list notes. Not prices, notes. Second, update one business card. Add one new fact, or remove one false belief. Third, check your behavior. Ask one question. Did I follow my rules this week, even when I felt emotion? If the answer is no, do not get upset. Fix the system. Make the rules easier to follow. Maybe you need fewer positions. Maybe you need less screen time. Maybe you need to check prices less. Maybe you need to write clearer decision rules. Rich investors do not try to be perfect. They try to be steady. Now let's talk about what happens when the market gets crazy, because it will. You will see a day when everything is red. Headlines will be loud. People will post fear. Others will post jokes. Some will say it is the end. Some will say buy everything. In that moment, you need a calm script in your head. Here is a strong inner dialogue you can use. I do not need to act today. I need to think clearly. My job is to separate price from value. If the business is fine, a lower price is not an emergency. If the business is broken, I do not hide from that fact. I will not make a choice to end discomfort. That last line is important. Many people sell to end discomfort, not because the business changed. And many people buy to feel included, not because value is there. Both are emotional trades. Rich investors do not try to win every moment. They try to avoid losing themselves. Now, let's put all 5 things in one clear list. This is the full system. 1, ask the owner question before you look at price. 2, use a not yet list to block FOMO and protect your circle of competence. 3, keep a watch list with value zones and require a margin of safety. 4, run a daily volatility drill with if-then rules so fear does not drive your hand. 5, do a leak check to protect compounding from lifestyle creep, hype content fees, and impatience. This is what rich people do daily, quietly, without needing to predict the market. And here's the best part. You do not need to do all 5 perfectly. You just need to do them more often than you do emotional reactions. Because every time you replace a reaction with a rule, you become harder to shake. Every time you choose patience over urgency, you protect your future self. Every time you say not yet instead of right now, you avoid a mistake that could take months to fix. Now choose one thing to start in the next 24 hours. Just one. If you want the simplest start here. Write your if-then rules. 3 lines. If I feel rushed, I wait 24 hours. If I cannot explain it simply, I do nothing. If I am losing sleep, I reduce risk in my life, not just in my portfolio. Those 3 lines can protect you for years. Quiet wealth is not built by being the fastest. It is built by being the calmest person. And the room when everyone else is being pulled by fear and hype. It is built by acting less, but thinking better. And it is built by letting compounding do what it only does for people who stay consistent long enough to see it.